Hello everybody, a very warm welcome to SD Capital's official YouTube channel. Today is Halloween, 31st October, so happy Halloween everybody. Today's session, at the end of it, as usual, there will be a free stock recommendation. For our new viewers, SD Capital provides free stock recommendation at the end of every session, and we have 2 sessions every month, so you get 2 free stock recommendations every month from us. So please subscribe to our YouTube channel if you are interested about our free stock recommendations. In our past videos, we have described with numbers how our stock recommendation do actually work. Please remember, our free stock recommendations are meant for longer term. So if you have booked some profit in the recent past following our free stock recommendations, that's okay. But please remember, these stocks are recommended typically for longer term investment. But before that, today's topic. So today's topic, it's going to be another round of question and answer. We get a number of questions in our mailbox via WhatsApp, via our page inbox, asking us about different stocks, different categories of stocks, demat account, etc. And we pick up few questions which we believe will benefit a number of you, and hence we are having these sessions. We already had 3 such sessions. If you want to, please go back and watch. We have discussed about particular stocks, and today's session is going to be 4th such session. But before that, I would like to remind you that SD Capital is most likely the one portfolio management company in whole of India who works on profit and loss sharing basis. There is no annual fee for us, no annual fee. We work on the basis of profit and loss sharing. If you make money, we make money. And if your portfolio is in red, we share the loss as well. So that is our level of commitment. And also, please remember that in our business model, you don't have to trust us. We trust you, because money stays in your trading account, your demat account. You don't transfer your investable amount to us. You trade, you can see your portfolio all the time. We maintain 100% transparency. Our core values, just once again to remind you: safety, transparency, and low cost. We try to keep your money safe in the volatile equity market. We completely recognize that equity market is volatile, and hence we have different mechanisms to ensure our clients' capital and a significant portion of the profit is always protected. We maintain 100% transparency, and our service is actually cost effective. As I described just now, we make money only when you make money. There is no fixed fee for us. And currently we are offering 3 different services. If you are watching our videos for long enough, you already know we have 3 services: create wealth, invest in retirement, and manage existing portfolio. You can get all the relevant details from our website. So if you are interested, please go to our website. And if you want to contact us, our mail ID is mail.sdcapital@gmail.com. I will repeat, mail.sdcapital@gmail.com. We have our Facebook page as well. All the details will be shared at the bottom of this video as usual. So now coming back to today's topic. So as I said, we are going to cover some questions, and I have questions written here which we want to discuss. Obviously, I am not able to remember those many questions. So I'm going to glance at the piece of paper here and repeat the question and then discuss. So the first question is, please suggest some penny stocks which you believe will generate significant return in next 5 years. Sorry. Penny stock is something highly risky investment. you need to first make a note why a stock is penny stock. Sometimes it is a stock where the company has performed really poor over the time. For example, Arcom. It was trading at a decent price few years back, and then the downfall started. Now it has hardly any value left in it. The other situation is new companies, absolutely brand new companies, where even the promoters are not well known, and hence they are trading at such a low price. So as retail investors, it's best to stay away from those stocks. Yeah, some of the penny stocks have done well in past, but believe me, it's not worth the risk. Please remember, many of the penny stocks get delisted over the time. So when you invest in 5 penny stocks, it's highly possible that 4 of them get delisted and you lose all your investment. So SD Capital firmly advise that being retail investor, it is best to stay away from penny stocks. Try to invest in blue chip stocks, stable companies, and your portfolio will generate healthy return over the years. Your capital will be safe. The second question, I bought Indusind Bank stocks in 2014. Average buy price was rupees 500. Should I hold now or should I sell the stocks? Indusind Bank. So you bought in 2014. In 2018 August, this was almost rupees 1900 2000 level. So I'm not. You haven't communicated or that whether you have booked profit at that point or not. But ideally, you should have booked some profit at that point. If you enter into a stock at a price level of 500 and it is around rupees 2000, which is like 4 times, then it makes sense that you book some profit at that point. If you haven't done so, we would suggest that for now, you stay put, you hold on to your positions. Indusind Bank is expected to go to the level of 1150, 1200 sometime in near future. And that will be the good time to exit from this particular stock. So guys and girls, whoever is watching our videos, please remember that if a stock is trading at a price point which is like 3 to 4 times of the price point where you entered, it makes sense to book at least some profit there. So please be mindful. The third question, how important it is to maintain stop loss when I am a long-term investor? So stop loss, why do we use stop loss order? It's to limit the risk. Say for example, you buy a stock at rupees 100. If you maintain stop loss at rupees 90, then as soon as the stock reaches rupees 90, your position will be closed and you pretty much per stock, you make a loss of rupees 10. What happens if you don't maintain the stop loss? It starts sliding. It may go down till rupees 70, rupees 60, wherever it can go. Essentially, your loss is growing. So that is why it's very key to maintain the stop loss. Now, for long-term investors, they can be a bit lenient about stop loss, especially if they are investing in blue chip companies. In that case, they just have to maintain stop loss considering the macroeconomic situation like COVID-19. But apart from that, if they are into blue chip stocks, stable companies, then actually stop loss is not that important. But if you are trying your hand in mid cap or small cap, please maintain strict stop loss to protect your capital. Otherwise, you may lose significant part of your capital. The fourth question, I bought 300 ONGC stocks at rupees 143 and then I again bought 100 ONGC stocks at the rate rupees 58. Should I hold on to my positions or should I sell? So one thing we have been telling consistently, that is, please do not try to catch a falling knife. Do not waste good money after bad money. If you have invested in a wrong stock that is going down and down, please do not try to decrease your average buy price by buying more stocks at a lower price, because it will continue its downfall. It is better to average the buy price when you are investing in a stock which is going up, which is bullish. ONGC, for that matter, it's not a company which is going to turn around anytime soon. The business it is into, the macroeconomic situation is not looking great, and hence it is highly likely that you won't be able to recoup your losses. It's better you exit and you invest whatever money you can retrieve from this into an alternate investment. You may buy some good stocks, you may just keep that money in bank, or you may do something else. The fifth question, between 2018 and 2019, I have bought 70 Reliance stocks. My average buy price is rupees 1300. I'm at 65% profit now. Should I sell, or are you expecting the price to go up further? Reliance, it's a very good buy. I would suggest, SD Capital will suggest that you hold on to Reliance stocks for now. This is expected to go up to 2400 or 2500 price point pretty soon. At that point, you should book some profit. Preferably, you should book you should at least sell 20 to 30 stocks of Reliance at that point. That way, you get back major part of your investment, and then you stay invested with the rest of the stocks. And Reliance is a company which we believe is going to only go up. The stock price and the company's performance both is going to only go up in near future, even in the longer term. So we believe it is a good investment, and you should hold on to this after the profit booking, as we explained. So today we are not going to discuss any more questions. So just like these people, you may reach out to us via our WhatsApp. You may reach out to us via our Facebook page inbox, via our website, or you can directly mail us at mail.sdcapital@gmail.com, and we will try our best to answer your questions. With that, today's session is now coming to an end, and we will strongly advise that at this juncture, the COVID-19 has actually brought a significant opportunity for Indian economy, which we are discussing in separate sessions, separate forums. But if you are not yet investing in the Indian equity market, it is high time you start investing. If you are a beginner, it will take 8 to 10 months for you to come up to speed, and then most likely you need to spend 8 to 10 hours per week to maintain your portfolio. If you are a beginner and wondering where to start, we have done 4 sessions as part of our corporate social responsibility to provide pointers for beginners. On this channel itself, if you go back and watch our July, August sessions, you will find those. So you can start studying on your own. If you don't have time for that, or if you believe that's not your piece of cake, please start investing with a portfolio management company who works in the partnership model. We have explained in one of our previous sessions that the business model itself for your finance consultant or your portfolio manager or your mutual fund manager, how they are charging you, that tells you the story. If they have fixed fee, then Obviously they are not interested to generate better return for you because their fee is fixed. If they are only into profit sharing, they will make you invest in riskier assets, because if you lost money, it doesn't matter to them. Only if you make money, they will get a better return. So please start working with companies who do share your profit as well as loss. And it is high time. COVID-19 have actually brought a great opportunity for Indian economy, and hence it is the right time to enter into the market. So now today's free stock recommendation, as promised, today's free stock recommendation is HDFC Life Insurance. SD Capital research team has got reasons to believe this particular stock is going to generate good return in the longer term. As again, the stop loss price, the target price, all of those will be shared with SD Capital clients only. But if you have watched our previous videos, you know how well our free stock recommendations perform. So if this works for your portfolio, please feel free to build your position into this particular stock. That's all for today, and we will meet again in 2 weeks' time. Take care. Bye.